The peer-to-peer lending industry, where did it come from? It was born right around the financial crisis, because that was a time when large financial institutions essentially stopped lending to consumers and small businesses. And a bunch of FinTech companies came in and filled the void. They built these amazing platforms online that allow these businesses to upload a little bit of information and then essentially receive a loan. A small loan, but a loan, and then receive it quickly. And that's something that large institutions can't do. Big financial institutions can't issue loans of the size we're talking about here, which is anything from a $15,000 loan to a consumer up to, say, a $100,000 loan for an institution. Imagine a consumer who will come to a platform and wants to get a loan. So typically they would have gone to a bank, now they can go online and get one of these loans. They have to input some information, and then the job of the platform is to put them into grades. And those grades correspond to the riskiness of that borrower, and then the platform will essentially assign an interest rate. A given loan, say a $15,000 loan, will actually oftentimes be broken down into much smaller increments, as small as $25. So an investor can come onto the platform and invest in a loan in increments of $25. That's called the fractionalization of loans. Eventually, institutions started to want to join this market too. Now, institutions didn't want to buy $25 loans. They wanted to have what are called whole loans, which is essentially an institution will lend the entire amount of the loan. That raised a set of problems and issues in the industry where you have retail investors, retail lenders, and also institutional investors, institutional lenders, competing essentially for the same loans on these platforms. And as you can imagine, this raised a bunch of problematic issues because people worried that maybe the institutional lenders were getting preferential treatment on these platforms. And that led to the peer-to-peer platforms having to deal with this issue of how to balance retail demand on the lending side with institutional demand on the lending side. Another aspect of the mechanics of these platforms is that when investors lend to a consumer, they are basically lending at par, meaning they're lending at $100. So there's no sense in which a lender can really bid, but the way these platforms work now is essentially you have to invest at whatever price that the platform gives you, which is basically $100 for a loan with a certain interest rate. And those interest rates are just basic grades, say A, B, C, D, E, F, with just fixed interest rates. Now, the loans themselves are typically 3 to 5 year consumer loans, and they're structured like mortgages in the US, where they are amortizing, which means they're paying down both the interest and the principal in an exact same amount all the way until the end. And that's attractive from a lender's point of view because you're not waiting until 3 years later or 5 years later to get a big balloon payment at the end.